Hello again. You are about to start a lecture with me. This is going to be the first part, and there are going to be 3 videos with this, which will stop. Just try to break it up a little bit for you. First things first, we're in 2.1 overall level of economic activity. This is what we're covering. 3 different lectures in these various things. So with 1.1, or it should be 2.1 overall level of economic activity, and then 2.2 measuring economic activity and HL calculations. When we get to the calculations portion, I'm going to send you over to Welker, and I'm also going to give you an activity that is HL only, okay? But SLs, you can listen to the lecture. You should listen to the lecture part of it, just explaining what these things are. And then finally, you'll get to the business cycle in 1.3. So first things first, we need to talk about a definition. Much like your paper ones, paper 1 part A's before, you had to give me a rough definition of what your micro definition would be. Here's your macro. You can use this, or you can come up with your own, but the study of nationwide economics as a whole, or how nations allocate scarce resources to fulfill unlimited needs and wants. Needs and wants, though, are measured in the aggregate. If you were going to use this, I wouldn't use the very last sentence. But we're going to talk about what that aggregate means, specifically more after spring break. So first of all, macroeconomists seek to investigate the following things, which you should have a pretty good handle on already, thanks to your projects, which you already did. But we're looking at full employment of resources, stable or gently rising price levels, which is also known as inflation, economic growth, whether that be through measures like GDP, equitable distribution of income, which we're going to get into a little more specifically later, and then external balances, or the balance of trade and balance of payments, and we'll talk about that in detail as well. So first things first, what is overall economic activity? It's best explained through 2 different flow models. One is closed, one is open. You are already aware of closed model, just consumers and producers, so there's no outside influence. But more likely, we exist in a world that has more of an open model that includes expected leakages and injections into the circular flow of money and resources. You could probably figure out what both those things mean. Injections might be added resources or money, and leakages might be losing those monies or resources. So looking at the first flow model, this is the closed, this is the one you've seen. Take a peek, you can kind of get an idea of firms, product, markets, the household consumers and resource markets are the places, and there's an ebb and flow to who takes what and where what goes, who buys what, who makes what, so on and so forth. Feel free to pause here if you want to get a better look at this. More accurately, your number 30 is going to look like this, your graph number 30, circular flow of an open economy. And the thing is, you're going to notice it's pretty much the same thing, except for the bottom 3 categories, shall we say. You've got financial, government, and other countries. And basically, you have to ask yourself the question is, how can those things either provide injections or leakages in this circular flow model? So remember, the one we've experienced the most is the government. We know they have fairly limited tools as to how they can try to dictate the flow of the economy. We know that taxes, for example, they can be both an injection or a leakage, depending on how those taxes are done. For example, if you say an income tax reduction, for example, when we had the tax cut bill. That is technically an injection into this circular flow because you're giving more money back to people. Same time, if you raise taxes, that's going to be a leakage. Financially speaking, you've probably heard of the Federal Reserve. Federal Reserve is basically dictates the interest rates of money and borrowed money. We're going to go into more detail with that. But basically, if you're upping or if you're, I should say, increasing or lowering your interest rates, that financial hit could be good or bad. So if you lower them, that means you're injecting, right? You have more people that are going to be willing to borrow or spend money. Whereas if you raise those interest rates, that might be a leakage. Following that, competition from other countries could manifest itself in a number of ways, whether that is undercutting businesses that are within your open economy by providing cheaper goods or services, or the opposite way around. Maybe those other countries are providing more luxury goods, and that could be one way, shape, or form. It could also just be general trade or the actions taken by other countries that could actually have an influence over this model. So that's the end of this first part. I will move on to the next.